to what extent do you think that you need the various governments in Africa to support that? Looking in Europe, we've got Bank of England, FSA, we've got the European Parliament all looking at various parts of fintech, and are you seeing the same in Africa?
So you are, and without calling out specific countries and not wanting to embarrass anyone or otherwise overly compliment anybody. All governments are looking at this, all regulators I should say are looking at this, but there hasn't as of yet been too much of an effort being put in the development of sandbox environments for the development of new technologies or new infrastructure plays to facilitate this. It will happen. Some of the priorities of some governments are being straightened out in terms of not competing with the private sector, in terms of light touch regulation and development of rules rather than participation into the game. There's also been some one-off advantages. I will mention certainly in Kenya the fact that Safaricom had such an overwhelming majority of the mobile market, enabled the regulator to literally work with one counterpart on the development of rules, which eventually allowed for the creation of M-Pesa and for the proliferation of M-Pesa. This might not be as easy, or I wouldn't call it easy, but it might not be as easily achieved as in other countries where there are several more operators competing with each other, and that's without even taking into consideration the competition in financial services and in financial services share of mind between financial services companies and telecommunication operators, and that's a whole different topic for the continent.
It's a difficult situation, I think, if you're a regulator in a market, right? Because on the one hand, you got to make sure that you protect the consumer and you protect the institutions, and particularly the systemically important institutions. On the other hand, you need to create enough of a leeway, and Matteo called it sandboxes, indeed, that allow people to thrive and to innovate and to allow to provide new products to customers. And that balance, we're starting to see people like the US government get right. Here in the UK, you're starting to see the FCA get right, and that's going to spread across the world. I think the key is that in many infrastructure-like businesses, we've seen, for example, the Indian regulator be very innovative. So the Indian regulator created a very interesting infrastructure regulation around ATMs, and now the ATM market in India has gone from 35,000 ATMs a few years ago to 235,000 ATMs.
We've invested in that.
Yeah,
so
okay. I know. We have to talk our own shop a little bit, and so they've done it. But if you look at most countries in Africa, in fact, pretty much every country in Africa, they're lagging behind on creating similar regulatory infrastructures that would allow ATMs to thrive.
And how does it affect your investment decision? Would you tend to sort of look at a market that's unregulated and see more opportunity there, or would you be more hesitant going into that market given that it's a bit of an unknown?
So we actually feel that regulation can be a competitive advantage for companies, and that is as an obvious result of the fact that the cost of regulation has increased. It has increased in the UK, it has increased in everywhere actually throughout Africa. As more and more regulation is introduced, companies that were able to thrive in the past and to get to a large enough size through economies of scale or otherwise, can tolerate the increased cost of regulation. Startups might find it much more difficult today than they did, 10 years ago or 15 years ago. As a result, investing in operators that are already, and I mean financial services operators that are already there, present and capable of tolerating the cost of regulation, constitutes I would call it a competitive advantage. It's that straightforward. So we see it positively. We think regulation is needed, of course, there is no argument around that, and I think we've all gone through a financial crisis, so it's relatively straightforward that it's needed. But we also think it is advantageous for investors like us and like many of your clients to have strong regulators, wise regulators, well-informed regulators, and we try to do, as Udayan said, whatever we can to help regulators to benefit from, at the very least, our intelligence from different markets, and contributing and fostering this sharing of information and knowledge.
I would add, at a very basic level, you have to assume that anything that touches money should be regulated.
Yeah.
Right? That's because, frankly, the chain is as follows. Money, core to an economy. If something goes wrong, ultimately it's the taxpayer that will always backstop it. So if you assume that, then you have to assume that these businesses ultimately need to be regulated. So going into a market with no regulation at all is probably as worrisome to us as going into a market with lots of regulation, because ultimately you know that the trajectory is going to be in one direction. So we always look at businesses with a view to saying that ultimately they will be regulated in one way, shape, or form. And we like to go into businesses that are prepared to be regulated.
And what's your view on what the sort of financial services landscape is going to look like in Africa over the next 10 years?
Well, I think
You take that.
that's a good question.
You take that.
I was just thinking that if you can help me with that, then maybe we don't have to worry about our investing, because then we can see that. No, I think it's a very good question. It's very hard to say. I would say trend-wise, there are probably three things that you're going to see from a trend perspective. One is clearly, as we talked about earlier, these very low-cost business models are going to thrive. So, the ability to service customers at low cost and at scale is going to become very much a characteristic of these markets. So whether it's loan distribution through the mobile phone or moving money around using an M-Pesa-like technology in different markets, really where the marginal cost of each transaction is very, very low, so which means that the actual revenue per transaction is low and the cost to the consumer is very low. So we're going to see very much a lot of that. The second is we're not going to see physical infrastructure-driven distribution in general. So distribution is going to move towards agent-led models, people on the street, or direct on the mobile. I won't say online, because basically people are going to move straight into the mobile. So you're going to see a lot of that. So most products, most interaction is going to be through those channels. And again, that comes back to point number one, which is your cost. Your cost is very low in developing a large infrastructure. And then the third piece of it is that I think you're probably not going to see this concept of these gigantic financial institutions that provide you every service in the world. What you're going to see is these niche providers of individual products. We already see that today with nano loans. We see that with different areas. So it's very much about, I provide you this service, the other guy provides you this service, and behind it there may be some larger institutions that are servicing these institutions.
So just to talk up our shop again, we recently published a piece of research. We write research, actually the two of us, between 3 and 5 a.m. every night. That's what we do when we're bored. And the latest one is called Breaking the Bank, and it's precisely about these specialized operators of chunks of financial services. I think you're going to see the demise of the mega operator, the universal bank. There will still be a need for them, but you will see a lot of your financial services as an end user, specifically in the African continent, being provided by specialized providers. I think you will also see an important role of financial education. Today, financial inclusion is not just about, or the lack of financial inclusion, it's not just about the price point that we were talking about earlier and the ability of financial services providers to be profitable at that level, but rather also about the knowledge of financial services and what it means to take a loan, what it means to repay a loan, more importantly, what it means to take life insurance and why and how do you take it. Do I go for micro insurance or do I go for an extended, rolling, more classical model? These type of thought processes are only starting now, and as a result we think financial education and the role of PFMs, personal financial management tools, will be increasing very significantly in the African continent. We are investing in some of these players, and some of our financial services investments incorporate a heavy component of financial education as part of the financial inclusion element, which at the end of the day simply means being able to access 2.4 billion clients, which is a good thing.